This video might just save you $20,000. Look, if you've been house hunting in the Twin Cities, you've probably been looking at things like mortgage rates and of course the price of the home. But you want to make sure you do not miss the hidden zip code tax, which, like I say, could very easily cost you $20,000 over the life of your loan. Just a few days ago, Minnesota released its finalized 2026 property tax data and information, and in there was a major change that definitely affects affordability around the metro. So in this video today, I am going to do my best to do some math, do a deep dive into the tax code so you can very clearly see picking the wrong zip code can cost you 20 grand, and we're gonna get after it right now. Well, just last week, of course, I made a video declaring St. Paul the value king in the Twin Cities. And on par for my luck, just a few days later, February 24th, 2026 to be exact, the state released its finalized 2026 property tax data, and it changed the math. So I am going to change my stance. Today, I am going to show you in great detail exactly what happened. We are going past the sticker price. We are going to look at three specific parts of the Minnesota tax code in depth that create a very real gap between two houses that look identical on Zillow. And you're going to want to stick around till the end because I have run the numbers for two of the Twin Cities' most popular neighborhoods so you can see the real world impact before you sign that purchase agreement. Well, before we get into the math, the first thing to have a little bit of an understanding of is your property tax bill is not just one big check you cut to the government, even though I'm sure it feels that way. It is actually more of a 4-layered cake, and every layer of this cake is charging you for something different. It already sounds like a delicious cake, I know. So layer 1 is the city. This is things like fire, police, snow plows, city services. That's layer number 1. Layer 2 is the county. This covers more regional services, court systems, social services, library, things of that nature. Layer 3 is the schools, and this is usually the biggest and most volatile layer, paying for things like teachers, buildings, and any special referendums voter just passed. That's going to get real relevant here in a few minutes. Layer number 4 is special districts and special assessments. This is usually the smallest slice of your tax bill. Now here's the key. Minnesota, these 4 layers do not just pick a random number. They use a formula to turn your home's value into your final bill. And I guess one piece of good news, before the city and county can even look at your bill, the state says, since this is your primary residence, we are going to take a portion of this house and protect it from taxation. This is called the Homestead market exclusion, and this is a sliding scale that literally hides a chunk of your home's value from being taxed. So that's where we're going to start. We are going to talk about what this Homestead exclusion is, how it works, and how it's calculated. I'm going to attempt to very clearly define what a Homestead exclusion is, and more specifically, how this freaking thing is calculated. And I'll tell you guys, before we get into this video, this is wild. After looking at how these taxes are calculated, just spending about 20 minutes here, I don't know how in the hell anyone is realistically supposed to be able to understand their taxes unless they are a CPA, because it's confusing. But we're gonna cover it. I'm gonna break this down and make it as simple as I can. So just bear with me. There might be some swearing, there might be some crossing of numbers out, but we are going to get this right, okay? So what is a homestead exclusion? A homestead exclusion is essentially a gift from the state of Minnesota, okay? If you own the home you live in, and that's the key part, you have to own and live in the home. If you own the home, but it's a rental property, you do not get a homestead exclusion. So you have to live in it. That's step 1, okay? Step 2, if your home is worth more, 2026, if it is worth more than $585,000, there is no homestead exclusion at all. So over 585, you can just throw all this out the window, okay? Now, here's how this works, and here's where it gets real messy. Up to a value of $107,000, you get that full market exclusion of $42,000 and change. This is already hilarious to me because good luck of finding a home anywhere in the Twin Cities that costs $107,000. But let's just say you found one. Let's say you found a home that was up to the max. Say that home was $107,000. It's still at the upper threshold. You can subtract that $42,000, puts you somewhere around $65,000. that would be your taxable value in that case. Now, nobody has a home worth $107,000. Everybody's costs more. Once your home starts exceeding the value of $107,000, that $42,000, you're too rich. If your home is worth more than $107,000, the state says you're too rich, and they start reining in that $42,000. It gets less. And again, once you hit 585 or more, it's gone. Okay, so hopefully we're making a little bit of sense. So now we're going to attempt to lay out some numbers and do a real world example. Okay, so let's say you have a $500,000 home, right? That is obviously well over the limit of $107,000. So the difference between $500,000 and $107,450 is $392,550. That $392,550, that's the amount the state is going to penalize you on, and they calculate it basically at a 9% rate. They take away 9 cents on the dollar for every dollar you are over that value of $107,000. So we're over by $392,550 in our example. We take that times 9%. That gives us $35,329.50. Okay, that is the penalty. Now, to determine your final market exclusion, okay, we're going to take the max number that everybody starts with, that's $42,980. We're going to subtract that penalty of $35,329.50, leaving us with $7,650.50. So we'll call that $7,651. So if you have a $500,000 house, following this exceedingly, wildly complicated formula, you take 500,000 minus 7,651. Your taxable market value, courtesy of this homestead exclusion, is now $492,349. Clear as mud? Awesome. Let's move on to the next step. Well, button up for this ride. My name is Chris. I will be your tax analyst and math wizard. I am also real estate agent extraordinaire. This is kind of what I do. Myself, business partner, Trevor, we cover the east and west side of the metro. If you are thinking about making a move to the Twin Cities and anything here piques your interest, like these exciting tax figures, contact info is right here. It's also down below. Let's keep it rolling with the video. Okay, we've got our homestead exclusion. We took our $500,000 home. We figured out how we calculate the homestead exclusion. Just did that. And now we've got, minus that homestead exclusion, we've got our taxable value of $492,349. Hopefully you guys followed with me on how we got there. What happens next? Well, the confusion continues, so we're gonna lay it all out right here. Taxable value of $492,349. Now, the state does not just slap a tax rate on that number. What the state is really kind of looking to do here is a currency exchange. So think of it like this. They want to take those big house dollars and turn them into small taxable units. So here comes some more from the Minnesota tax code. The rule in Minnesota for 2026, this one rule is relatively simple. For a homesteaded home, up to the first $500,000 is converted at exactly 1%. For homes over $500,000, that first $500,000 is converted at exactly 1%. Every dollar over $500,000, that gets converted at 1.25%. That's beyond the scope of this video, just a little bit of information for you. So we have our tax value of $492,349. We multiply that by 1% and we get $4,923. Now, these are your tax capacity units. 4,923 is the only number that Minneapolis and St. Paul are allowed to look at when they start their math. This is the universal starting line for both Minneapolis and St. Paul. Okay, so at this point, both Minneapolis and St. Paul are looking at your $4,923. That's the tax unit. And now both of these cities get to decide what to charge you for the privilege of living in one of those zip codes. This is what is known as the local tax rate, but think of it really as a service fee. And let's start with Minneapolis. In our example, let's start with Linden Hills first. When you pull up the certified 2026 tax data for Minneapolis, you're going to see a number that looks freaking terrifying. It's 109.8%. Okay, so I know what you're thinking. How can they charge me about 110%? That's more than the house is worth. Take a breath. Remember, they are not charging you, they are not taxing you on that $500,000 price of the home. They are only taxing you on these tax units that we converted in the last segment. So they are charging you on that $4,923. Think of it like a service tip on top of those units. For every $1 your house produced or is worth, the city and county want $1.10 back to pay for your police, your snow plows, those Hennepin County libraries, okay? So the math is relatively simple, sort of, at this point. We take our 4,923 times 1.098% gives us a dollar value of $5,405. For Minneapolis, so far, that's where we are at. We are at $5,405. Now, let's hop across the river and do the same thing for St. Paul, okay? On the city and county lines, the St. Paul looks like a bargain. Their combined fee is only 95% compared to Minneapolis that was at 110%. So we'll take our same taxable unit, $4,923 times St. Paul, which is 0.95, gives us $4,676. So far we had Minneapolis $5,405. We have St. Paul at $4,676. So if we stop the video here, St. Paul is winning by about $700. But this is where we're going to keep pulling back the layers and pull out what is this St. Paul tax trap that was just finalized a few days ago on February 24th, and that was the schools. All right, at this point, we have looked at how both Minneapolis and St. Paul tax. We've looked at the fees coming from those various municipalities and from the county. The next piece, and this is where things start to separate, is how school districts affect your property taxes. And this is the part where it might break the budget. So let's get into talking about this. And the first thing to understand is school districts in Minnesota tax you twice. Isn't that fun? They have two separate buckets. And here's how it works. So bucket one is the unit fee. Using our example, we've got our taxable unit of $4,923 that we found in step 2. To get school tax rates, you multiply those by the district's base rate. This is for things like lights, buses, the buildings, the basics, okay? 2 buckets, that's bucket 1. Bucket 2, this is the voter bonus. This is a tax that voters approve at the ballot box, and it does not, this is what you have to understand, this one does not care about those taxable units. This one is going to hit you on your full taxable market value. In our example here, $492,349, and it's going to take a piece of that. So now let's look at how this breaks down in Minneapolis with our Linden Hills example, and over the river in St. Paul with our Mac Groveland example. Okay, so bucket 1, the unit fee. The city of Minneapolis, they charge 28.5%. So using our taxable unit of $4,923 times 28.5%, we get $1,403. That's bucket 1 for Minneapolis. Bucket 2 we talked about is the voter bonus. This is where they are going to tax you on your full taxable value. Again, our example, $492,349. And Minneapolis tax that at a rate of 0.14%. So doing the math there gives us an additional $689. So the city of Minneapolis, the school district portion of that tax bill now becomes $2,092. With me so far, I know it's clear as mud. Moving right along. So now we are going to look at how St. Paul does this same thing. So for starters, again, we have two buckets. Their bucket 1 is already higher. Remember, bucket 1, that's the unit fee. Minneapolis was taxing you at 28.5%. St. Paul is taxing you at 35%. So, same math. $4,923 times 35% gets you $1,723. Remember, Minneapolis in the same category was $1,400. So St. Paul already about $300 ahead on the school district side of things. Here's the shocker that occurred on February 24th and changed since my last video that really made St. Paul jump up here in taxes in not such a good way. So they approved a $37.2 million referendum that was just certified February 24 of 2026. This is bucket 2. This is the voter bonus bucket. And it kind of exploded in St. Paul. They are now taking double the Minneapolis rate. Remember here, bucket 2 Minneapolis was taxing at a rate of 0.14%. St. Paul here in this same bucket is taxing at 0.29%. So St. Paul, with that voter approved referendum, is tacking on an additional $1,427. Remember, Minneapolis was not even $700 there. So St. Paul finishes here with the school district tax at $3,150. Minneapolis was just over $2,000 at $2,092. So when you add those buckets up, you can see St. Paul is $1,058 more than Minneapolis for the exact same $500,000 home. And as we saw, St. Paul was actually taxing lower at the city and county level. Where the math changed, where the trap is because of this referendum that passed in St. Paul, and that school levy chunk of your taxes just went. Okay, well, let's try and break this down and put a bow on this. So in our previous video, I did crown St. Paul the value king because we were at that point we were looking at the lower city levies, which was 5.3 in St. Paul versus Minneapolis's 8%. Obviously, St. Paul was the runaway winner, and based on purchase price and city level math, St. Paul is still the winner. What happened was, like we talked about earlier in this video, on Tuesday, February 24th, Minnesota Department of Revenue released the certified 2026 property tax summary, and this was the first time we got a look at the full picture, that being city, county, school district, and then these voter approved referendums. First time we saw that, first time that was officially calculated for the year, and that changed the reality. That certification revealed that the St. Paul School District had that referendum approved at $37.2 million, and that wiped out the city level savings, as we just saw in our mathematical laden example. So what we now know is this: St. Paul is still the cheaper to buy city. Talked about it a lot. Median household value is about $50,000 less on a citywide level in St. Paul. Still cheaper to buy into St. Paul. St. Paul is more expensive to own in. However, that at this point we can say categorically hands down for an identical $500,000 property. And like we talked about, the sales tax. St. Paul has this sales tax now at 9.88%, almost 1 full percentage point higher than Minneapolis, making your everyday purchases and items also a bit more expensive. That probably adds up to anywhere between $300, $500, $600 a year, obviously depending on how much you spend and things like that. So pretty interesting, a lot of math. Hopefully you guys can get the picture at this point. St. Paul definitely has a cheaper on average entry point, but property taxes are definitely more expensive. So hopefully that was not too confusing. I have never done this much math on screen. Hope you guys found this video helpful as well. If you did, please give me a like, bang that bell, and subscribe so we can keep you posted on what is going on. In-state friends, out-of-state friends, what do you think of these property taxes? I've talked to some people from down more in the southern part of the U.S., and their property taxes blow me away when I hear how low they are compared to what we have here. So I'm always curious to hear what is out there. My name is Chris. Thank you again for watching, and I will see you again soon on the next video.